Hi, Robb Rothrock with Safe Retirements Group, and today I want to talk about ways that you can minimize taxes in retirement. Now, before we get too far into this video, I'm not a CPA, I'm a financial planner, so anything that you do before you act, make sure you run it by your CPA or by a qualified tax professional. With that being said, we do talk to clients about this on a frequent basis, and people are always wanting to know, how can I minimize taxes? Well, the first way is contributing to a Roth IRA account. A Roth IRA will build tax. You cannot deduct the contribution, but all the gains and all the money you take out of it in the future is 100% tax-free. Now, on a regular IRA or a regular 401k account, that's not the case. You can deduct the contributions 100% today. Every dime you take out of that account in the future is going to be fully taxable income, and it can even put you into a higher tax bracket depending on where it falls. So, and when you're 70 and a half, you have to start taking out required minimum distributions every year, and those are fully taxable, but not with a Roth. So now, what if you make too much money to contribute to a Roth IRA account? Well, you've got two options. Number one, you can roll the money from a traditional IRA to a Roth IRA. There's no income limits for that. That will be a taxable event in the year that you do it, but maybe you can do it a little bit at a time, year after year after year, to start building up that Roth account. So that's one way you can do it. Second, if you're self-employed, you own your own company, you can set up your own solo Roth 401k account and contribute up to $19,000 a year. There's no income limits to do it this way. There's no income limits that apply to a Roth 401k. And if you're 50 or older, you can add another $6,000 to that, and your company can contribute part of your salary. So you can actually put up to $56,000 a year into your own solo 401k. You can split some of that between Roth and regular. If you're married, you and your spouse can both do that. And if you're still working, most employers, or I'd say probably about 75% of employers now offer a Roth 401k option. So take a look at that. You can't deduct it now, but you will benefit from it later, especially if tax rates go up. So as it stands right now, the tax rates are lower, the lowest they've been in a long time for the high tax brackets and the mid tax brackets. That's set to expire in December of 2025. So now's a really good time to be looking at a Roth 401k or IRA account. The second way is for non-qualified money, for money that's not in an IRA account or 401k, is to look at possibly in the future, if you're retired maybe now, buying tax-free municipal bonds where the income that's coming off that account is fully tax-free. So that's another way. If it stays in a brokerage account, any income you're pulling off of it in the way of dividends, in the way of capital gains, if you're selling, if you have gains, that's going to be taxed, but not if it's in a tax-free municipal bond. So the third way you can defer some taxes is in an annuity. And again, in a brokerage account, dividends and income is going to be taxed if it's not an IRA account, but it's going to be taxed in the year you receive them. But in an annuity, that interest will be deferred until you actually take money out of the annuity. So an annuity is a way to defer some taxes for later. And the last way is a Qualified Longevity Annuity Contract, or a QLAC. And what this allows you to do is it allows you to defer some of your required minimum distributions. So it's a long-term annuity contract that you can not start taking income on as late as age 85. So if you live a long time, and hopefully we all do, then two things. Number one, it's hey, things are going to be more expensive in the future. Now you've got another stream of income turning on at age 85, and it will be taxable then. But in the short term, you can defer up to 25% of your IRA account with a maximum of $130,000, in which will reduce your required minimum distributions at age 70 and a half, and you can defer that up until age 85 and start taking income from it. So there's four ways that hopefully you can, through a combination of what's the best way for you. Does any of this make sense for you to do it? It depends on your circumstances, but we can certainly talk to you about that and see if we can help you devise a plan to give you the most tax efficient retirement possible. That's it for today. Thank you very much for watching the video.